Good afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. These are the top headlines that we're tracking at this hour. Indian equity benchmarks hold on to gains. Nifty and Sensex trade 1/3% higher. MSCI adds HDFC Life Insurance to its Global Standard Index and removes Union Bank of India from Global Small Cap Index. Tata Steel is the top Nifty loser today after the company's quarterly profit comes in at a two-year low. What's also weighing is the delay in selling its Southeast Asian business. HCL Technologies, on the other hand, is the top Nifty gainer after the management sticks to the 14 to 16% revenue guidance target. Ultratech posts a 100% jump in profit, beating the street estimates. Good afternoon, Devina. Well, some respite coming in. I think for majority of this session now we've sustained the gains.
Yeah, the early morning gains being held on to. You did see a brief period post-opening where the markets actually dipped and fell down into the red. But post that, you've seen a good recovery. But it's been pretty volatile. As you can see, lots of peaks and troughs through the day. And now we're back up towards the highs of the day, about 0.5% higher for the Nifty 50. Taking a quick look at India VIX then, before we move on to the Nifty Bank and the internals of the index. So India VIX has actually come off today about 3.5% lower. As a global snapshot, remember Asia today was positive as well. Europe, US yesterday were positive. Europe should come up today right now on your screens. The FTSE, the CAC and the DAX. They're trading more mixed bag, but it's more positive. So 1/3% higher for DAX, CAC's trading higher by about 3/4, and FTSE is absolutely flat. Coming to the internals of the index itself, in terms of the gainers and the losers, the heat map will come up on your screens, and many more gainers this afternoon. HCL Tech for one, that big 5.5% move on the counter. You've seen them taking a move on the upside on the revenue. 14 to 16% revenue guidance is what they've given. Tata Motors is doing well. Coal India is up about 2.5%. Hindalco is up 1.9%. Other IT stocks, Infosys and TCS also follow suit. And then you've got a heavyweight like HDFC Bank up about 1.5%. Yes Bank today continues to gain some ground, but not at those levels of 90 that it was in early morning trade, but just somewhere around there. Amongst the losers, Tata Steel is down about 5% on the back of numbers. Cipla is down 3.7%. UPL, Axis Bank, IndusInd Bank are losing out as well. I just want to see Ultratech Cement and where that counter is trading at, if that could come up on your screen. They just reported their numbers just a few moments ago. Standalone profits at 1,199. EBITDA was also much higher than street expectation, 2,550 in terms of standalone EBITDA, but the stock actually came off 1.6% lower for Ultratech Cement after staying stable through the trading session. In terms of the mid caps and the small caps, the MRR function will show you exactly what's been moving up and down in today's session. So from the Nifty mid cap 100, while the larger index is doing well, the mid caps not so much so. So down 0.25% for the Nifty mid cap 100 index, with the losers stacking up. The biggest loser being Reliance Infrastructure, down about 11%. Following that is Cummins India, Diwan Housing Finance, and some of your other smaller names. Sterlite Tech is also down about 4% gainers. Dish TV takes a breather today, 2.5% higher. Apollo Tyres, Punjab National Bank and Escorts up about 2% in this session. So all in all, a still large cap driven rally in today's session. Mid caps not contributing all that much. But what's been happening in the futures and options space, considering today is the weekly options expiry, Navneet is going to highlight that for us. Navneet.
Thanks for that, Devina. And as you rightly highlighted, the gains are led by large caps, and it looks like it is a short covering bounce because Nifty is now almost at the high point of the day, 10,918, where it's trading. No major build up when it comes to the August futures. Premium intact at about 23 to 24 points. For the bank Nifty, which did witness some bit of fresh shorting in yesterday's trade, we have seen open interest surging by about 6% for this one. Let's see by the end of the day. Remember, these could be intraday positions also, which tend to get unwound towards the end of the session. It's the weekly options expiry day. So if you look at the options data, the maximum open interest on the call side is at 11,000. On the put side, it is at the 10,800. So that was a wide range that we were looking at. But remember, the combined premium on the 10,850, which was at the money strike when we started the day today, was suggesting a range between 10,760 to about 10,940 on the upside. So probably now on the upside, we can watch out for the mark of 10,950, which will be in focus. Let's see where the closing comes about. Very quickly on the stock future side, HCL Technologies, which is your top gainer in the Nifty. On the technical side, some positives as the stock has crossed its 50 and 100-day moving average. On the future side, we are seeing fresh long positions coming about, and even even on the cash side, the move has been led by higher volumes. As you can see on your screen, the white line is projecting today's volumes vis-a-vis the average volumes that we've seen in the last 20 sessions. And the other side, on the other side, you've also got Aurobindo Pharma, which has reacted quite positively to the numbers, which did beat street estimates. The operating performance was good. This one too, by the way, is trading very close to its 50-day moving average. And on the cash side, the volumes have been higher. The stock's been trading with good gains of about 7%. In fact, it did touch 52-week low on Monday. It bounced back from there. And today, on back of good set of numbers, we are witnessing fresh long positions here. And Cummins, that's the stock in focus. After cutting the guidance for both export as well as domestic business, the stock has seen a big fall. Remember, the guidance cut came in the conference call today. The stock's fallen in quite high volumes. It's also down, by the way, 30% on year-to-date basis. And the futures indicating a lot of short positions being taken, even at current levels, as the stock touches its 52-week low.
All right, that's a quick wrap on what's been happening to individual stocks within the derivative space. Let's take our conversation slightly more global and get in a perspective from Richard Harris, Chief Executive at Port Shelter Investment Management, who's joining us on the show right now. Richard, thanks very much for taking out the time. What have how have you been making sense of all the various moving parts globally in terms of all the news flow that we've been witnessing, what's been happening with regards to the trade tensions, currency manipulation, and the impact of all of that on emerging markets?
Well, I think obviously most of the action's been happening in the major markets. So I think what we're seeing is a general slowdown. But what's holding it back, of course, is that the Fed still has some bullets. It can still reduce rates. So the US market is taking some courage from that and holding up. And at the same time, the US economy actually hasn't done too badly right throughout the trade discussions. So all in all, the US is pretty well holding most other things up. Economies elsewhere don't look as if they're going into recession. But it's still not a terribly good picture looking further out, partly because emerging markets often take their prices off the developed markets.
Okay. Richard, the question to everybody's mind is, with PBOC doing what it is doing and today's move of pricing the midpoint UR reference rate at 7.0039, which is what I think the lowest since 2008. How, if this process continues or doesn't reverse, how materially negative could it be for sentiment around the Asia Pacific region, if not a larger region?
Well, I know the issue with the yuan has been taking up a lot of attention, but really I see it more as a distraction from what we're seeing with the trade talks. The US, I think, acted rather precipitously in declaring China a currency manipulator, because they're clearly not. We've seen the Chinese economy look pretty weak in 2018, recovering a bit in 2019. You can forget about the official GDP figures. That's what really happened. And I think that what we should have seen last year was quite a significant depreciation of the renminbi. The authorities decided to hold it quite strong, and that was perhaps the right thing to do. But in reality, if we were looking at market forces, the renminbi would be much cheaper than it was now. So I don't really think the Americans are in any sort of position to declare China a currency manipulator. And on top of that, it hardly matters, because there are very few, there's very little recourse that the US has, even if China was doing that.
Okay, but having said that, irrespective of whether the labeling is right or no, if the yuan pricing is the yuan is led to drift, above this or below the 7 mark, how much do you think it will have an impact on the sentiment? Because then the world probably believes that the spat/war is not coming to an end anytime soon.
Well, I think that's right, but I think that's largely been brought into prices, especially in developed markets. People are now saying that, well, the major Chinese strategy is to wait until Trump goes in 2020. Well, he won't go until the end of 2020, 2021 already. So we're already looking at 15 months or so. I think that's built into the markets quite comfortably. I think what the markets are basically saying is, okay, we can just about survive with trade tariffs as they are. If we see another 10% going on all of China's exports, that could be a lot more serious, because that's likely to drive up prices even more. But it's a strange thing with economics, with checks and balances. If the renminbi weakens so as to take some of the bite out of those trade tariffs, we may well see a lot less impact overall on the global economy than we think. Certainly less trade, but trade, of course, is only a portion of the much larger economic activity that we see in the world.
Hi, Richard. Good afternoon to you from India. Well, the impact is definitely being felt for the emerging market currencies after the Chinese yuan crossed that important threshold of 7, and which has also led to a lot of FI selling into equities in a couple of the markets. What I want to understand is, are you witnessing a trend where money is now flowing into safe haven assets like gold because the gold prices have been inching higher?
I think there's no doubt about that. You only have to see what's happening with gold and also what's happening with the fixed interest markets, because we've seen the long bond in the US have a significant move, the yields moving downwards significantly. We've now got something like 15 trillion of the world's bonds, most of them sovereigns, yielding negative amounts. Now, this was thought to be next to impossible, that you would actually have to pay the bank to hold your money. That's a very worrying development, because I don't think policymakers have got the handle on exactly why rates are negative and how far they could go and for how long.
Richard, the important question then is, do you see this trend continuing now for the remainder of this calendar year, and that is depreciation of yuan and money now flowing into safe haven assets like gold?
I do. I don't necessarily see them as being related, however, but I think there's a strong momentum trade now that's basically looking at maybe the long bond going pretty close towards zero. Who knows, maybe even negative. We never thought other bonds would go negative, so why not the US? I think that's one trend that's happening, and it's slightly discordant with the equity markets, which are still, if you think about it, relatively strong. Compared to the falls we've seen on the bond markets. The Chinese currency, yes, it's going to have an impact on emerging markets. It's going to add more strength, I think, to the US dollar, which has been mildly strong all the way through. I don't really see that trend changing, but I think that it's important to keep the two separate when you're doing your analysis and not think the one is dependent on the other.
Richard, one last question from my side. We're in an interest rate regime where most of the central banks have been talking about being slightly more dovish and bringing down interest rates. The Indian Central Bank cut the repo rates by about 35 basis points yesterday. The other central banks too have been following this path of easing. Do you feel that this is somewhat, in a way, also supporting global equities in a way, and that could probably mean the backlash that we're seeing on the back of slower economic data could start to turn a little bit from now?
Well, I think certainly lower interest rates are generally seen as being good for equities. It enhances people's borrowing capacity. It reduces costs. So I think all in all, it's supporting the equity market. But I think it's not a particularly healthy situation when policymakers feel they have to support the equity market. You know, equity investors are risk investors. If things go down because of various economic factors, they should be taking it on the nose. They shouldn't be waiting for the Fed or any other central bank to bail them out. Yes, of course, the Fed is mainly focused on the economies and the economic factors, but I think they're probably taking a slightly too unhealthy look at the equity markets and saying that, well, equity markets are one of the indicators and we have to keep them up. I don't think that's necessarily the angle they should be looking at, but it's the angle that they're going to be doing. So I can see interest rates being on a downward track for the foreseeable future.
Okay, Richard, we'll leave it at that. Thanks much for taking the time out and being with us today and giving us your thoughts. Appreciate your time. Well, that's the global view on the show. Now, Ultratech numbers came a while back. Standalone numbers were better than estimates, simply because, one, the EBITDA per ton up about 52%, much better than what the estimates were. I think the estimates were about 1206, and the number is at about 1474. So that's part one. Margins stood up 26% versus 19%, but somehow the stock has taken a beating. I would reckon that maybe in part due to revenue numbers, just about okay. Well, 9729 was the expectation, 9794, so there too about a 15% growth, but some of the stock is taking a bit of a beating. Remember yesterday a couple of experts who had come said that somehow this cement cycle doesn't quite look as strong as otherwise as some of the other companies are saying, but I can't quite fathom really something that I'm missing, because the numbers, at least the Ultratech numbers on all counts, seem to be better than what their estimates were, and it's not that the stock really went into these numbers on an extremely strong parameter, so
Neeraj, the volume is pretty much, I think Nikki's poll was throwing a volume figure of 19.7. They've reported a volume of about 17.8, which pretty much reflects the weak demand environment everybody's been talking, and higher operating performance is owing to the prices, because it's a pan-India player. Realizations will definitely be higher on back of good price, and also cost efficiencies seen. Petcoke prices were lower on year-on-year basis, so operationally good, but a miss on volume, I guess.
Well, maybe that's the reason. I mean, because you probably take these volume growth numbers as an indication of how the demand is, and maybe the quarters ahead could also throw in such numbers only. That's probably likely the one verdict. On very high volumes, I might add, 4.5% down now for Ultratech Cement. So quite different from what some of the mid-cap numbers had thrown up, both on the volume and the operational front. Operational numbers still okay, volume growth numbers not quite there.
And for a stock which after its the last quarter results was the only one that went up the way it did. In fact, it almost made highs of closer to 4,900 thereabouts. From there, it's been just a clear glide down for Ultratech since the last 1 month or so.
Yeah, the Aditya Birla Group stock somehow not having the best of times. Aditya Birla, Vodafone Idea and Grasim as well getting beaten down, and now Ultratech Cement finding no favor. Well, getting a global local market voice, Shibani Sarkar-Kurian of Kotak Mahindra AMC joins us right now on the sidelines again of the conference, Emkay Conference. Shibani, good having you. Thanks much for joining in. Well, we'll have the data points out today. I reckon that the flows into the equity funds at least would have continued. Don't quite know about the debt side, but my question to you is, if the monies continue to come in, has stock picking been relatively easy because there are opportunities presenting themselves, or is it relatively difficult because the stuff that you want to buy is not quite correcting?
Hi, a pleasure to be here. So good afternoon, everybody. So yes, if you look at the markets today, the markets are volatile because it's a conjunction of both global as well as domestic events which are driving market forces at this point in time. We've been maintaining for a while that in these volatile markets, the best opportunities present themselves. So if you are looking at stocks from a bottom-up perspective, looking at stocks which have strong cash flows and balance sheets, in this kind of a scenario where there could be some correction in some of these names, this is possibly the opportune time to buy. From an overall market perspective, clearly the market polarization towards large caps has been continuing, and mid caps have been taking a beating. However, as we have been also stating that the opportunity in the mid and the small cap space, if you have a 2-year kind of a time horizon, is great, and that's what we are doing essentially across our portfolios. We are looking at stocks which have corrected within the mid-cap space. However, keeping in mind that these stocks clearly have to have strong cash flows as well as strong balance sheets, and therefore present an opportunity. So I think we would look at this kind of a correction and volatility in the market more as an opportunity, and therefore presents itself to take positions in some names. Of course, it has to be more bottom-up in nature. Sectoral calls at this point in time, given large cap, mid cap kind of a scenario, it's more mid cap and small caps, and therefore more bottom-up stock picking. That's what we are doing across our portfolios.
Okay. So when you're talking about looking at mid caps and small caps right now, the entire gamut of the pain that we've been seeing since 1.5 years now, I mean, that doesn't seem to be going away. While most of these stocks are at really attractive valuations, which in any normal course of business, if this wasn't a time where we're witnessing global slowdown, would have been used as an opportunity to enter, and people would have made a beeline for these stocks. But they still seeming to shy away from there. Why do you think that's happening still?
So I think a lot of factors. Of course, there is a significant amount maybe of risk aversion that is also set in. The mid-cap valuations, when you look back a couple of years ago, when the mid-caps clearly outperformed the large caps, there was a sharp run-up that happened. So some degree of froth was also created at that point in time. The froth has corrected. Now it's more than corrected. It usually is the case that when things start correcting, they tend to correct a little bit more than what is required. What we've been seeing essentially, if you look at mid cap versus large cap, now valuations are even lower on a 1 year forward basis than what it was in the beginning of 2014. And we've clearly seen, if you look at history over the last 10 years or so, whenever that kind of situation arises where mid cap, large cap valuations fall beyond a certain level, there is usually a retracement that takes place. So that's what we are seeing both in terms of valuations. And like I said, valuations is not the only thing that you need to look at when you're picking stocks within the mid-cap space. Quality and governance is something that cannot be compromised. If stocks have fallen because there is an issue in terms of governance or balance sheet related issues, these are not the stocks to be really nibbling at. We are clearly looking at good quality stocks, as I mentioned, strong cash flows and balance sheet, low leverage, which have presenting themselves at reasonable valuations, and therefore looking at stocks.
Okay. Any sectoral bent that you have, Shibani, right now?
So from a sectoral perspective, one sector where we continue to remain positive is in financials. Within financials, our preference continues to remain with the private corporate banking space, where while we have seen stress emerge in the last few months with some fresh names coming up and possibly some slippages as well, some of these private sector corporate banks where the larger stress which emerged over the last 3-4 years, those stress levels have been dealt with. Their provisioning coverage now is significantly high, and therefore they are well positioned. Some of these banks will also benefit as and when the resolutions take place on the IBC side, and they clearly have balance sheets which are more granular in nature, less chunky, and as a result of which that's a segment that we are positive on. The second segment that we are looking at, maybe not just immediately but with a slightly longer term view, is the capital goods space. While this is clearly a beaten down segment and one can argue that there are no immediate signs of recovery, our belief is that two things. One, public capex will start once again, something that has been absent over the last 6 to 8 month period. Government spending in terms of infrastructure, specifically roads, affordable housing, water, etc., will emerge, and that will be a driver of growth. Capacity utilization levels have also started inching up, and as a result of which, once you get through this near-term phase of uncertainty and you take a slightly longer-term view, capital goods could be a space where opportunity presents itself. And a corollary to that, in terms of infrastructure, cement is also a segment that we like. While this, given the monsoon period, you've seen some of the price hikes that some of the cement companies had taken have been retraced. However, as I said, once the public capex picks up with specific emphasis on roads as well as affordable housing, the volume growth pickup should also start over a period of time. Structurally, we believe that cement companies, because of the cost benefits that they are enjoying at this point in time, as volume growth picks up, the operating leverage also flows through, and that results in better profitability. So these are some of, from a sectoral perspective, some of the sectors that we like across our portfolios.
Okay, that's the call on cement. Well, cost efficiency is definitely visible in the numbers that we've been, but in terms of operational leverage, the volumes seems to be not picking up because of the weak environment. Shivani, just a word on, you mentioned you are bullish on capital goods space, but the numbers which we've got, the commentary has not been encouraging. In fact, the private capex is still missing from the system.
Yes, I would agree with you. So if you look at capex and you look at the investment cycle, clearly there has been the deficiency on part of the private capex cycle really not picking up. Our view is that it is still going to take some time for the private capex cycle to revive, because the ingredients of revival are still not fully in place. However, our bet is more that the public capex, which has been absent actually for the last 8-10 months, with the government spending coming under pressure, that cycle will start to pick up slowly. And therefore, that is a part of the overall sector that we are more positive on. Private capex is still some time away, I would agree, and once that starts to improve, we will possibly see a better trajectory. However, right now what we are saying is that the public capex and improvement on that front is something that we will watch out for, and therefore, like I said, one of the sectors which is a corollary to the infrastructure revival story is more cement, which is largely geared to demand coming in from road construction as well as affordable housing.
A word on IT, which has been resilient with the markets witnessing relentless selling pressure in the last 1 month, but Nifty IT still managed to register gains of about 3%. And the numbers have not been bad, at least from the large cap IT companies, though mid caps have definitely disappointed the street. Do you see money moving to that side? Also, because now rupee depreciation seems to be creating a tailwind for them?
So IT, I think, as a sector has been more a defensive bet across for most market players. Our view on IT has been that we prefer large caps over mid caps. The kind of growth acceleration that you saw in mid cap IT companies last year, that growth has clearly shown signs of deceleration, and the quarter numbers are there for everyone to see. Even within the large cap space, while first quarter has shown that deal momentum has been fairly strong, what is really missing is now those large transformational deals that we saw last year, which drove growth. Right now the deal wins are there, but mostly centered around digital, and therefore there is some shift that is happening away from spends in the traditional segments towards more digital, and only those players who have capabilities are able to capture this kind of an opportunity. So while on the growth front we are still okay, we are still seeing growth, one needs to really watch out for how things trend in the second half of the year, specifically with respect to BFSI and US large BFSI, large banks in the US, and what kind of spends these banks actually incur for the remainder of the year. If there is a large pullback, then the kind of growth that you've seen now could see a slowdown towards the second half of the year. Structurally, on the margin front, we do believe that most of the IT companies have been facing margin pressure because the inherent cost of doing business has clearly gone up, and as a result of which margins are under pressure. Even if you look at a long-term basis, despite the depreciation of the currency, margins have structurally come down for most IT services players. And while in the near term, because of the currency depreciation, you may see some relief in terms of margin decline, but structurally we do believe that margins are on the way down. So IT as a sector, our preference has been large cap over mid cap, but within the entire sector as a whole, we've been slightly cautious overall, given the uncertainties that are building in from a macro environment on growth, as well as the possible margin pressures that could remain.
Okay, we'll leave it at that, Shibani. Thanks much for taking the time out and being with us today and giving us your thoughts. That's the view from Shibani Sarkar-Kurian on the markets at large. Just going back to Ultratech's numbers, because of the way the stock has fallen down, 2.5% down, not as low as 4%, but certainly under pressure. Before we get an analyst, Nikki Mirchandani, our expert Johnson right now, to give us her sense of what stood out there. Nikki, the volumes, I guess, haven't shown an uptick.
Yeah, clearly operational performance is better than what the street was estimating, but if you look at volume growth, the number is 2% higher, and we were expecting a growth of 8%. So there is a clear sense of disappointment creeping in from volume numbers. But if I address the basic numbers first, revenue, we've seen a 15% uptick there. Net profitability is shot up 100%. EBITDA is up by 57%, and margins have come at 26 compared to 19%. The volume figure here, I'd like to take a minute where the domestic volumes are up by 3% at a number of 17.2 million ton, and exports have actually come down by 7% at a number of around 0.6. Overall, the numbers are around 17.9. We were estimating a number of around 19.7 million ton, which implied a growth of 8%, but then it's just a 2% uptick there. What has essentially contributed to better than estimated operational performance is the higher revenue and the lower cost. Power and fuel expenses, freight and forwarding, all of these expenses have come down in the range of around 3.5% to 6%. Higher other income, for that matter, has contributed to bottom line performance of the company. In terms of the EBITDA per ton performance, logistic cost has declined 5%, energy has declined by 2%, and the raw material cost, that has come down by 2% to 489 rupees per ton. If I look at the EBITDA per ton value, that's also something, it's better than what the street was estimating. It's clearly the disappointment which is creeping in from the volume figures, which is in turn weighing on the counter right now.
Thanks for that, Nikki. Avinash Gorakshekar Johnson with a quick perspective. Avinash, just that one word on the volumes, because otherwise everything else in the numbers is okay. How negatively would you take the miss on volumes?
No, I think the volume growth is definitely a miss, but I would believe that realization growth has been pretty good. More importantly, input costs have actually come down, and that has actually helped the overall profitability to grow both at the operating level and at the net profit level. I think volume growth is something which one would like to hear out from the management as to what kind of growth numbers could pan out in the coming quarters. But I think volume growth number, clearly I think markets were expecting a slightly better number. The number has come in slightly below what the street expected. But I think clearly on the realizations front, the volume drop has been more or less been compensated. So I think it's a fairly good number on the bottom line. But yes, on the volume side, I think there's a fair bit of disappointment.
Avinash, the 2% growth also which you're seeing on volume, that could be owing to the Binani assets which have come under Ultra Cement now, and 15% top line growth, out of which 13% is coming on back of higher prices, which may not last in the second quarter now.
Yeah, I think pricing is definitely going to be a key element, Navneet, and I think the market should obviously like to factoring in more stronger volume growth, considering that Binani capacity would also contribute. But I think clearly in terms of the blended realizations, I think if you look at the top line and the realization growth in this quarter, realizations have definitely gone up, and I think to sustain these realizations, I think hopefully since the second quarter could be a slightly sluggish quarter, considering it's a monsoon related quarter, we could see a little bit of moderation in realizations in the coming quarter.
All right, Avinash, we'll let you go on that note. Thank you so very much for joining us. Appreciate you taking out the time. Mangesh Badang of IDBI Capital Services is also joining us on the show right now. Mangesh, thanks very much for taking out the time. A quick look at the operational performance suggests that UltraTech has been in line with street expectations, but the big disappointment was the volumes. Do you think that this is something that could be a pain point for them going forward into the coming few quarters as well?
No. So the company has mentioned in its presentation that they had 10 films which were under shutdown in this quarter. And in my opinion, probably that's what would have led to the lower volume performance. And generally, the volume decline is in line with what we have seen for the other companies. So if you notice, ACC was flattish, Ambuja was down, and various other companies, barring a few regional companies, have reported the volume, which is in line with what the industry has done. In anticipation of this weaker growth, I think UltraTech has preponed their film shutdown, which has resulted in relatively lower. So I was working on with 6% growth in volume. Compared to that, it has come down at 2%. But in lieu of that, the pricing as well as the profitability performance has been really good. So I think volumes is not something I would give more weightage to at the time, because the EBITDA growth is around 72%, which is much more than what we as well as the street were expecting.
Mangesh, point well taken. I would also agree with the point that volumes is something that seems to be a little missed, but then EBITDA per ton performance has been fairly decent. What I really want to understand right now is the fact that cost saving measures essentially have led to, and higher prices that we've seen in quarter one, which have led to strong set of numbers, at least on the operational front. Do you expect that continuing in quarter two? Do you expect cost reduction to come through again in quarter two? And clearly pricing power seems to be a miss. So can we expect lower margins going forward?
So generally, it's a seasonal, September is a seasonally weakest quarter. And generally in this quarter, what we see is that volumes are the lowest in a year. So definitely volumes would be down. And what we have seen in the industry, there has been around 15 rupees relative decline in pricing till now. So that is going to happen. But YOY, the numbers are going to be fairly robust the way we have seen in this quarter. And I think post this quarter results as well as the next quarter's results, we are going to see upgrades on earnings of UltraTech.
All right, Mangesh, we'll leave it at that. Thank you so very much for joining us this afternoon. A quick dissection of Ultratech Cement's numbers and what the stock could do going forward from here. The stock, though, has recovered from the lows of the day, and so have the markets. We're now on the brink of breaking past above that 11,000 mark, just 6 points away, 10,994. That's a big spike that's come in the last 5 minutes of trade. And I just want to quickly look at the contributors and what's leading to this charge in the markets. The Bank Nifty 2 is now up about 280 odd points. So starting off with the big movers on the index first off, hardly any losers now, but talking about the gainers, you've got Bajaj Auto, Bharti Airtel, the likes of HCL Tech now 6%, Tata Motors is up 3%, Reliance Industries, that's a big move on Reliance Industries, so I think that's one big gain that's coming there. And HDFC Bank, both these heavyweights, 2.5% at the highest point of the day for Reliance Industries, 1137, and HDFC Bank too, a similar spike seen in that one. Two heavyweights really aiding the index doing what it's doing, and Infosys also adding to the bandwagon, 792 on Infi now. That is up about 2% as well.
You probably reckon that some of the high FI holding stocks would maybe have the better move in the last 5 or 10 minutes of trade. Let's wait and watch if that lasts. Brijesh Singh of Stock Access with us. Wonder if he's going out and buying this. Brijesh, are you doing any trade on the Nifty or the Nifty Bank right now? We're trading almost at the highest point of the day.
Good afternoon, Neeraj. See, no doubt, Nifty on a hourly chart after making the high lows formation and seeing the volatility, but the oscillators were been giving a positive divergence, so which indicates the pullback rally. Now, this pullback rally, which I've been witnessing, is might at least go to the level of 11,140, or even try to go beyond 11,200 mark. So when I posted my strategy for Nifty, once Nifty has gone to below 10,900, because I was looking, if it trades below that, then my risk reward ratio would be in my favor, and one can look out to buy Nifty below 10,900 with a stop loss of 10,830 and play for the target of 11,050. But suppose someone has missed it, then still there are chances, if anyhow, in this later half, if Nifty trades below 10,950 or say 10,940, as an aggressive trader, one can go for a buy call with the stop loss of 10,890 and play for the target of 11,000 or even 11,140. So right now, what I mean with this, chances are that Nifty might go and touch a level of 11,140.
What about individual stocks then, Brijesh?
See, I have two buy calls in my list. Number one, the first buy call in my list is ACC. No doubt, after the Ultratech Cement, we have seen a sharp correction in cement stocks. But what I have been witnessing is stock is after making a triple bottom formation at 1475 or 1480, stock has given a pullback and it was trading firmly above short-term moving average. Now, somehow, if it trades below 1580, that was my strategy. If I'm not mistaken, right now it's been trading somewhere around 1550. With the strict stop loss of 1530, one can go for a long side and play for the target of 1620 to 1622. And another buy call is TCS. Now, the TCS on a shorter term to a longer term time frame of the charts, it's been trading in higher tops and higher bottom formation with overall bullishness. So I was been looking, when I posted this call, it was trading somewhere around 2240 or say 2245. Now, if I'm not mistaken, it's been trading somewhere around 2270. Anyhow, if it trades below 2260, then one can go for a long side. We'll revise the stop loss. My stop loss was somewhere around 2200. We can revise that thing to 2230 and play for the target of 2290. If I'm not mistaken, the 52-week high is somewhere around 2292. If it gives closing above this 2292, then what I've been witnessing, we might see a sharp rally towards the level of 2370 to 2390 zone also.
Since you have a buy call on TCS, the other IT player which is doing well and is the top gainer on Nifty on back of earnings today, it's up 6%, and I'm just looking at the exchange data out of the total quantity which has been traded, and of course today's volumes too have been on the higher side. Almost 50% of that is being marked for delivery. 6% higher at 1083. I believe it's also crossed its 50-day moving average today. If somebody is holding longs here, what should be the target on the upside?
SCL Tech you're talking about?
HCL Technologies.
Yeah. See, Navneet, the overall trend is been bullish. The stock after making a high of 1187 and got corrected, and after making a base at 990 zone, it has moved up. And what you have said is absolutely right. The volume breakout has been there. If you take a 10-day volume average, the stock today has moved up with a significant volume, which indicates overall strength. Now, suppose someone has bought at the lower level, or suppose someone wants to buy at present rate, I would be saying till stock doesn't trade below 1040. So as a trailing stop loss can be 1040, or as a trader, suppose someone wants to play at the present rate, keeping a stop loss of 1040, chances are that stock might try to touch a level of 1125 to 1130, where the previous swing high has been there. And once that is surpassed, then stock might even touch the level of 1170. So present rate can be used for accumulation purpose, play for the target of 1125 and above with the stop loss of 1040.
Some respite for the markets, and for a change it's green across the board besides the India VIX, which is down. So you've got the Nifty IT index, by the way, which is up 2% in trade. FMCG has gained about 1%. Bank Nifty is now trading above around the mark of 28,000, and Nifty has touched that 11,000 mark after a while in today's session, which is up about 140 points in trade. Let's bring in our next guest then. Lancelot D'Cunha of ValueX joins us on the show now. Hi Lancelot, good day to join us. Some bit of recovery is seen after a while now, because the markets have witnessed relentless selling in the past many days. How are you approaching the markets? Are you finding value anywhere after the sharp correction that we've seen?
Well, yes, we are finding value, in some of the areas that have got beaten down, especially some of the banks and the NBFCs. I think the stronger NBFCs will benefit from this situation whereby liquidity will move to the strong NBFCs at the expense of the weaker NBFCs. So while maybe for a short while all NBFCs would get impacted, but I think as the next 6 to 8 months plays out, we'll begin to see these stronger NBFCs actually be able to improve their net interest margins, expand their loan books, and maybe grab a larger share of the business in the marketplace. So that has been an area where one can look at, identifying the good quality NBFCs and stay invested with them, or even buy them even at these levels. Similarly with banks, we've seen NPAs, etc. And now, banks like IndusInd Bank, to an extent, ICICI, Axis have also come off their highs. And we could begin to start looking at these banks as as beneficiaries of the trend of lowering of interest rates, and that would probably spur them on to greater growth going forward. So I think that the opportunity, short-term opportunity, lies here, for the next 6 months. I think the recovery in sectors like auto and pharma, etc., will take a little longer time. Maybe auto will get some indications as to how the festive season pans out, on the back of a good monsoon, maybe with rural demand picking up. We could see an improvement in the festive sales, and that is an indicator to watch out for, whether the retail recovery is again, going to show some green shoots, or is going to take a longer time. So based on that, then one can look at investing in those sectors as well.
Okay. Got that. I just want to focus back on the movers on the index, and right now it's just the Nifty, which has made that dash towards 11,000. I don't know whether the mid caps and the small caps have participated equally, because at the start of the show it was stark underperformance, marginally higher, but yes, they have picked up from the lows of the day. Joining us right now is Ajay Bagga. He's on the phone line with us. Ajay, thanks very much for taking out the time and speaking with us. You were recently here with us, and you spoke your mind pretty freely about what's been happening to the equity markets. Some signs of relief right now, but nonetheless extremely volatile, almost on a daily basis. What's the sense that you're getting with regards to how does one tread this way now forward for the equity markets, and particularly investing in the more high quality Nifty 50 names, which suddenly seem to be the flavor yet again?
Yeah, I would still say wait it out. The good news is our studies, our talks to people are also showing that the PMO itself is very seized about the condition of the economy. And, both the Economic Advisory Council and the Niti Aayog have been tasked by in suggesting ways to tackle the slowdown. And we are expecting, strong measures to be announced in the almost immediate future. So if this, for example, if this tax goes, it gives a sentimental boost. And even if the FPI selling slows down, that's a huge positive for the markets, because that has been a big drag on the markets and the sentiments.
When we're talking about $1.5 to $2 billion of foreign money which has been pushed out of the system post the budget, the equity markets have corrected about 9% since then. If that money, and if by what your conversation suggests, if there's anything meaningful that comes about on this ground which suggests, some positivity with regards to the foreign money coming back to Indian shores, how much of a bigger amplified move on the upside can be anticipated, rather?
All that money will not definitely come back altogether. So, it will take time. But yes, the market is very heavily short, especially the FI positions are very hugely short. So there will be some struggle to take the market through those very heavy shorts. But, I think it can move up quite strongly based on this. But I would wait and watch. Let the notifications come through. That would be a better time. No problem. You lose a bit of the upswing. That's not an issue, but not a market to be jumping in, because fundamental issues are there. And hopefully, what our news is that the government is very serious in now trying to address it. So suppose a package comes for auto, a package comes for real estate, that will be immediately very positive for the markets.
Ajay, in fact, I was coming to the topic of auto, and it's clear now market is waiting for government's intervention to revive that investor sentiment which has been dampened in the recent past. So talking about auto, I think the representation has been already made to the PMO. What sort of package can move the needle now? Of course, the industry has been demanding lower GST from 28% to 18%. Also, there are talks of higher depreciation being provided for these companies. So according to you, what will move the needle for autos?
Yeah, it would be a combination that we would look for, right from incentivizing the scrappage policy to giving some kind of a tax cut. 2008, that's what the Indian government moved very fast in cutting the excise almost overnight, and that was very positive. So I think something on those lines would be what the auto industry would look forward to. A GST drop and some positive stimulus into the economy, and telling the banks not to pull back loans both to retail as well as to auto dealers. So funding.
Okay. Ajay, thank you so much for taking the time out and joining us, Mr. Bagga. I really appreciate you taking the time out.
Thank you, Neeraj.
That's a quick word from Mr. Ajay Bagga. Well, let's see if indeed what the Economic Times reported this morning or yesterday about the FPI surcharge rollback happening this week happens or no. Very quickly, the other big factor that is working in India's favor is the pullback in crude prices. And I think important to address that as well, because irrespective of what they're doing on the demand front or on the supply front, the low demand is not quite helping the prices of crude, and therefore they've come off. Today's session might be marginally higher, but certainly up in trade. Let's Lancelot, because of the fall in crude prices, are you going out and making any investment decisions? I mean, wondering, this may not be really sustainable, but for now it looks like the upsides are capped.
Well, I think yes, at one point it may be difficult to sustain this, the fall in prices for a longer period of time. And at the same time, because of the slowing global growth, you may see the demand for crude globally also begin to taper off. And that would mean that, the upside on crude prices could be limited. So I think in a sense, since we are importing, significant amounts of crude, it actually is good for our economy because our input costs would remain low. The subsidy that the government bears for some of the fuels would also be lower. So the burden that would be there would be lower. But it's very difficult only on one thing to go and buy stocks because what is more important is the demand for the products. While the crude derivatives would go as raw material costs in various industries, so the costs of raw materials would be kept on a relatively low level. I think the major issue with our economy and the country's corporates is that demand has slowed down from the consumption from the consumer, and that is affecting great growth engine which was in place for so long. Now we see this as a probably cyclical slowdown because of maybe buildup of overcapacity and and to some extent needs to absorb a bit of slowdown. But I think that this coming festive season would be an indication as to whether it's just a temporary thing or it's more long drawn out. So at this point of time, it's better to just wait out, see how things are moving, and then after that really commit significant amounts of money.
Okay. Well, today though, some of these stocks, the usual suspects, have moved up, despite the fact that crude prices are higher than what they were at the start of the trading day. But yesterday's fall is certainly helping. Reliance is up 3%. I'm not saying that's because of crude, but it's up and about. Some of the OMCs have gained in trade as well. Do watch out. Crude coming off is a big positive, and if indeed some of the other technical factors are taken care of, it's positive for India for sure. Let's get in a voice. Azleen Ahmed Johnson right now to talk about this precise move. Azleen, good having you. Thanks much for joining in. Now, Saudi Arabia may be trying to urge some of the participants to try and ensure that there are supply-side constraints at a heightened level as well. But the demand picture seems so bleak right now that almost everybody that we speak to or read about says that crude is headed lower. Are you in the same camp?
I think it will depend a lot on what happens with the U.S.-China talks or the trade, whether there be any possible resolution to the trade war. Because right now, as we saw over the last week, oil prices have been trending lower, and that was mainly after U.S. President Trump announced that he was going to impose more tariffs on China on 1st September. So that really pushed the market lower because it just added to the growing worries about demand growth. So I think that there is the prospect of oil prices going down, but if the tariffs are imposed on 1st September and there are no indications that the China-US trade war can be resolved anytime soon, I think that, prices will be vulnerable on the downside. But as you mentioned, the supply side, OPEC Plus, has been quite compliant in the output production restraint. So we're not really swimming in crude supplies at the moment, especially with Iran and Venezuela output still out. So right now, as you say, yes, it is still the demand picture that the market's focused on, and the market is getting quite concerned about demand growth, which is putting pressure on the oil prices.
But what's the near-term trajectory to your mind, Azleen? I know it will depend on a lot of factors, but with the data that you have at hand, crude lower from here or higher from here?
I don't know. I think the thing is that what we've also seen is that overnight, while the crude prices fell, during Asian Day today, it recovered about half the losses made. So I think that I don't think we're going to, unless something more bearish or something negative is announced by the U.S. or China. I think that we're hitting, in the short term, I think we're pretty much near the lows. I don't think that we're going to see Brent at the $50 level in the short term, as I said, unless there is really some bearish news regarding the U.S.-China trade talk. I think crude prices have slipped quite a bit. And, at some point the market may start looking at the supply and realize that there is some constraint in supply, especially with the OPEC Plus output cuts.
Okay, we'll leave it at that, Azleen. Thank you so much for taking the time out and joining us and giving us that perspective. That's Azleen Ahmed with her thoughts on what would happen to crude going ahead. By the way, some stocks which are under a bit of stick include one, Endurance Technologies. Numbers came in, I think, at about 2 o'clock. And I think post those numbers, the stock has only gone down, gone one way, and that is down. So locked on a 20% circuit right now. Clearly, the market not impressed with what they've delivered. We'll, of course, talk about that in a bit. Remember, again, an auto-exposed company, and therefore not surprised that this has happened. A lot of stocks looking wobbly right now. Before we take that break, one name on which there is certain slide down is Cummins India, and that too with reason, of course, because Cummins has announced a guidance cut, and I think that is what is weighing in on the stock in the session today. 8% lower currently. Let's wait and watch if indeed this were to drift lower during the course of the day. Brijesh, just one quick thought. Cummins India as a trade.
See, right now, Neeraj has been quoting at 600. It should have not broken the previous swing low of 652 or say 653. Now, that too with increase in volume. But at this rate, but at present rate, I would not be going short. Rice can be used for going short. So if it trades somewhere around 620 around, then one can play for a short side with the stop loss 650 and play for the target of 570, 575 as the initial, as the first target, followed by 550 as the next target.
All right, I think the max numbers flashing on your screen, just watch out for that one. 62.76 crores in terms of its profits versus 48.97 crores, and that's seen a big spike. The stock there now is up about 6.5%. Volumes, remember, slightly thin on this one, but we've spoken to the management on multiple occasions, and they've really spoken about, at least pre-budget, his views were that there's to be a lot more that comes in from the government side in terms of a push to make sure that the sector can revive in terms of the total orders that they give out. But not bad at all for their revenue numbers also, 1392 odd crores, and the stock's up 6%. 50,000 odd shares have been traded there. We're going to slip into a very short break right here. When we come back, we'll get you closing strategies, we'll get you a dealing room check at about 3:15 odd, and lots more to discuss with our guests. Stay tuned.